Y'all, it's been a busy day and I don't know where to even start, but I think the main topic is a possible contracting economy here in the US. So let's start out with some of the data sets we got out today. This first one is the ISM PMI, standing for the Institute of Supply Management Purchasing Managers Index. And this one's for services related activity. What we've seen is that it contracted in May, falling to 49.9 versus the 52.1 they were expecting it to come in. So it came in low, and it dropped from last month in April, falling from 51.6. The ISM's price index ticked up to the highest level since November 22 of 2022, when inflation was above 7%. And what's to blame here? We talk about it every single day. Tariffs. Tariffs are still the issue, and it doesn't seem like it's getting any better. Now, the next thing we got is ADP Research's National Employment Report. We got private employers adding 37,000 jobs. So there are 37,000 jobs created in May. That's the slowest pace of the private sector for hiring in more than 2 years from what we've seen. The Wall Street Journal economist forecasted a whopping 110,000 jobs to be created. So this was really a big miss. And this is down from 62,000 jobs created in April. Job growth being weaker doesn't really align with the positive sentiment we've been seeing come through. So this could be a shift from what we're seeing. Now, this immediately raises concerns that the job market is slowing down, because this is mainly what the Fed's been watching to determine whether or not they're going to cut rates, because we got tariff uncertainty with ongoing negotiations. Is the trade war going to happen? Is it going to get worse? And then on top of that, interest rates are still high. So everybody's watching Trump. Everybody's watching the Federal Reserve. And what do we get right after this private jobs report came out, this ADP jobs report? Well, if we go to Truth Social, we see ADP number out. Too late, Powell must lower the rate. He is unbelievable. Europe has lowered 9 times. What do we even do right now? Like, it's just back to back. Like, man, I swear you cannot take a break in this market, in this economy, everything moving on. It's something new every single day. And what a lot of people are thinking is whether or not the Fed is more inclined to cut rates after this private jobs report. But what I hear is that many people don't watch this private jobs report. What they're more so watching is the BLS's jobs report that we're getting out this Friday. The Bureau of Labor Statistics releases that one, and I think that one's more so related to government jobs. Fact check me on that one. But let's see where we sit on the CME Fed Watch tools. So seems like we're still sitting steady for June 18th, so that's just a couple weeks away. July 30th, we've seen a jump in the odds that people expect the Fed could cut. This risen as high as over 30%. Looks like it's taking a breather. September 17th is the meeting we're really watching, and yeah, it looks like 56.5. So more than half of participants believe that the Fed may cut rates by 25 basis points come in September. So that's a 0.25% from where we're at, lower. And by December, almost 40% that we're getting a 25 basis point cut, so a 0.5% by the end of the year. Who knows if that actually happens or not, because what I forecast is with this tariff uncertainty, inflation expectations are still high. Companies are raising prices, and we'll get into that a little bit later, more so on the companies raising prices. But what does that do? That increases inflation. And we got inflation reports that the market participants are watching, the Fed's watching, the president's watching, everybody's watching inflation prints. And a lot of economists and analysts believe that inflation will start spiking in the months of summer, which are here. We've arrived. So June and July are some to watch, and many people are now getting worried, including Fed members like Fed Bostic, and I believe Lisa Cook was the other one, believing that we could see inflation last a little bit longer, which makes it very complicating to determine whether or not they're going to cut rates. With inflation being high, but we got job numbers coming in kind of weak, kind of weak. 37,000 versus Wall Street Journal's 110,000 jobs created expectations. That's really showing that there's some problems going on. So we're going to keep on watching this and see what arises from this. But we also got some talk from Fidelity Investments today. What they let us know is that, one, there's something good going on. The average savings rate in 401k plans has risen, at least for all of this is in relation to Fidelity Investments 401k account. So who knows if this is what we're seeing in other companies that hold retirement funds, but this is Fidelity Investments, so I just want to make this clear. So the average savings rate for 401k plans with Fidelity Investments is at a record high of 14.3%. And that's of the income in the first 3 months of the year, according to Fidelity Investments. We also seen the number of 401k millionaires. They're saying that they've gotten a little bit more rare than they were because that amount, that number of 401k millionaires has fallen 4.6% from the fourth quarter. Now, with the moves we've seen recently in the markets and with us almost at all-time highs again in the indices, I'd imagine this has changed since then, but this is what we've got news-wise today. This is what people are reading. The share of workers with outstanding loans on their Fidelity 401ks increased in Q1 from 17.8% to 18.8%. So about a percent increase from where we were, but that's still pretty low versus the 20% range we've seen about 10-20 years ago. So that's not really alarming, but an increase is worth noting. We also seen Dollar Tree come out, and what Dollar Tree revealed is that they remain optimistic. And think about what the Dollar Tree sells, right? It's in the name. They're appealing to a lower income cohort. Dollar Tree, they sell smaller packaged goods, cheaper alternatives, and they do see tariff pressures on their prices, at least in the near term. More consumers are expected to shop there for cheaper alternatives, and the CEO mentions that it's higher income customers that have been really driving their growth, and these higher income customers have incomes of 100,000 or more. Now, what's this really saying? Well, one is that people are getting tighter on their budgets, and two, people aren't shopping at Target if they normally shop at Target. They're probably shopping at Walmart or something. And what we're seeing is a lot of people shopping for alternatives here at these dollar stores. So we've seen Dollar Tree, we've seen Dollar General, and they both align with each other. They're looking very happy right now because of all the mess going on, higher prices. It's making these stores look pretty well. Now, the next thing we're going to get into is there's this taco trade is overdone and investors should tread warily, according to a growing consensus on Wall Street. Now, this article is by Jules Reimer, and we're not going to read nothing out of this. I just wanted to put it on this chart, and I hope you can see this chart. Let's make sure. Okay, so what this chart is over are U.S. household ownerships of stocks in percentage of total assets. And what we see is that we're at a high. We're near an all-time high, and it looks like we're at a high as stocks are near all-time highs. So right as inflation expectations begin to rise on the long-term expectations of pretty much everybody. We were just talking about how everybody's expecting the tariff hits to start pressuring prices. Summer is going to be a month to where inflation really starts surging rather than going down closer to the Fed's target. And if that sticks, that could be a problem. But throw on top of that, that job data we just got from the ADP with the jobs created coming in a lot lower than many people were expecting. This could possibly be a problem. Well, what else do we got? Well, we got economic data for manufacturing and services contracting too, from what we've seen from the ISM, the Institute of Supply Management. What does that sound like, y'all? Let's type it in together. Let's go to google.com and let's type in stagflation definition. What is stagflation defined as? Well, Let's forget the first one. Let's go to simple terms. Stagflation is an economic situation where prices are rising. So we got inflation. But the economy isn't growing and there are high rates of unemployment. It's a combination of stagnation, economic slowdown is what that stands for, and inflation with rising prices. And then think about this from the Fed's perspective. Let's go back to September. That's when people was expecting the first cut. If jobs are slowing down, we get the big jobs report Friday, but this is just like the pre-jobs report, so to say. So job created are coming in weak. Inflation is expected to come in a little bit hotter for the months of summer. And the economy is starting to slow down. People are pushing off these big ticket purchases. People are budgeting more. People are shopping for cheaper alternatives at Dollar Tree. And then on top of that, stocks being at near an all-time high, which is near a psychological barrier, because once you're at an all-time high in stock, like some people want to take some money off the table. What if everybody wants to do that at the same time to avoid a possible drop down that we've seen in markets just a few months ago, like literally 2 months ago? Look at how much lower we were in all of these indices: Bitcoin, SPY, the Dow Jones, the Nasdaq. VIX is still pretty low despite stocks being near all-time highs. Gold's been on a tear. Where does that put us? So are all of these worries just noise, with the jobs report coming in weak, with the economy slow down, with businesses not buying as much inventory or hiring as much, with the Fed weary as to whether they need to cut rates because they're balancing between a slowing economy and rising prices? Because when the Fed cuts rates, what does that do? That's a form of stimulus that allows people to buy more. And when people buy more, there's more demand. Let's say supply stays the same. Simple economics 101, prices go up. That causes inflation. So why is that a problem? Well, stagflation. Persistent high inflation combined with high unemployment and stagnant demand in a country's economy. And stagflation is kind of like it's kind of bad because it's like a recession with rising prices. So just thinking about that, you can see why it's so confusing for the Fed right now and why they want to continue to wait and see despite all of the mess that we got going on. And Americans are saving more, so that's good in a way, but they're saving more means that they're spending less, and where they're spending less is on they're spending more on cheaper alternatives, so they're not buying the more expensive alternatives. They're saving more in savings accounts, retirement accounts. We see that they're buying stocks, so personal stock accounts. They're saving more in all of these type of accounts, but they're spending less is kind of what I was getting at. So cheaper alternatives. They're pushing back on these big ticket items, and especially the ones that need to be financed because these interest rates are pretty high. And that leads to even more further slowdown. But you're expecting prices to increase because of these tariffs. So what we see is that 75% of businesses impacted by Trump's tariffs are one way or another raising prices, according to the New York Fed's regional business survey of firms here out there in New York and northern New Jersey. And this survey was conducted between May 2nd through May 9th. And this was before the tariff mess, the real big one with China and then the courts coming out. So what we see is that almost 1/3 of manufacturers, and so about 33% of manufacturers and 45% of service firms, have fully passed along all of their price increases they've gotten from tariffs to consumers. So consumers are paying for that. Then another 45% of manufacturers and about 33% of service firms have shifted some costs to consumers. So prices are increasing, but are they done? Do you expect that they're done? Considering that all of this mess is still going on. Trade talks are still going on. And we're going to talk about a little bit more after that. But I don't know that prices are done increasing. And it makes sense to, all right, tariffs raise prices. Prices might rise in the summer just because of like people trying to front load tariffs again, and tariff impacts actually finally kicking in, and it's even more uncertain. So all of that makes sense. But then today we got even more from Trump here. So let's just go to Truth Social and let's look at this man while we're talking about him. Are you able to look at that? All right, perfect. So what did Trump tell us today? He was talking to China, and what he revealed is that they're extremely hard to make a deal with. And this really shows that temperatures are really rising, tensions are rising, and that tariffs can stick around for a little bit longer and may even be higher for longer. Y'all remember when we were saying interest rates were higher, are going to be here higher for longer with the Fed? Take out interest rates. Well, keep that statement, put it aside, and in the front of the equation, put the little plus sign, and before the plus sign, put tariffs are higher for longer and leading to even more uncertainty. Now, we did get some kind of good news today from Jameson Greer, the United States Trade Representative. He said that the European Union had offered a credible starting point for talks and mentions that the doubling of steel and aluminum tariffs hasn't necessarily helped that. And him saying that the credible starting point, like that doesn't really tell us too much, but it's just kind of like news that, hey, it's going well. I mean, they're starting off realistic now. But what if those talks don't go well? Those are some of our two largest trading partners, China and the European Union. So a lot of uncertainty regarding that. And then on top of that, the BBB, the big beautiful bill, the Senate's trying to get that pushed and signed into law by the 4th of July. And what this is expected to do is increase the deficit by 2.4 trillion over the next decade. What kind of feedback are we getting on this? Well, Elon Musk is back at it again and saying we don't need to bankrupt America. He's not a fan of it at all, and probably start to aggravate Trump a little bit. But I mean, if you think about it, increasing the deficit, you're going to increase government spending, but increase tax cuts, and you're probably not going to generate the revenue, especially if these tariffs get canceled, to fund the missing revenue from the tax cuts, and you're increasing this deficit. The government's or the Treasury is going to have to issue more treasuries to fund that debt. They're going to have to issue more debt, and that could, in the near term or even in the longer term, we could be in a new cycle like all of the news articles are saying. But we could be in a scenario where these yields on these longer treasuries, despite Treasury Secretary Scott Bessent saying that the 10-year is going to go down, it seems like the 10-year Treasury is going to go up, assuming they don't allow banks to start buying more of them to bring these yields down. Because if these yields continue going up, because they need to attract somebody to buy them, somebody needs to lend the government some money to fund itself, that's going to keep increasing borrowing costs. And that's the problem we're having right now. We got tariffs increasing costs, we got interest rates increasing costs, and with this big beautiful bill, technically it's relying on tariffs, which increase prices and increasing the government's debt load and the government needs to pay its bills and keep the lights on. They're going to have to like raise more money, which increases the borrowing costs for everybody. So that's a tough one, man. That's a tough one. But I mean, we're here to keep on watching, y'all. I'll be here tomorrow to present my findings, but that's what we got today. Thursday, I think Thursday is going to be pretty quiet. We'll watch whatever comes out tomorrow, and remember, mark your calendars. Friday is the day for jobs. See y'all tomorrow.